Good day, everyone. Welcome back to Phillip Roundtable, where we're gathered today to discuss one of the most hotly debated topics in the investment horizon: growth versus value. For decades, investors have been divided on which of these approaches to investing is superior. While growth investors seek to identify companies with the potential for rapid earning growth, value investors search for undervalued companies with a solid financial footing. Today, we are privileged to have with us a distinguished panel of panelists, of experts, each with their own unique insights and experiences in the field of investment management. Our first panelist, Christopher Chan, is the head of fund management at Astute Fund Management. Christopher has over 30 years of experience working with multinational, regional, and local financial institutions in fund management. He has managed equity, balanced, and fixed income portfolios for institutional, private, and retail clients in investment research. He has covered local and regional equities, global fixed income, and currencies. Prior to joining Astute, Chris was the head of investment management at M Investment Bank Berhad. He also held senior positions at IRA Berhad, Prudential Fund Management Berhad, Huang DBS Investment Management Berhad, ING Funds Berhad, and ING Insurance Berhad. Before embarking on a career in fund management, he was an equity analyst with IHP Research Institute and MGI Securities. He holds a Master in Business Administration, Banking and Financial, a degree from University of Hull, UK, and is a graduate of the Institute of Chartered Secretaries and Administrators from UK. Our second panelist, Ivan Khoo, is the Senior Fund Manager of Fixed Income at Amanah Raya Investment Management in Berhad. Ivan joined the company in August 2018 as a fixed income fund manager. He started his career in TA Investment Management Berhad as Product Research and Development Officer. Prior to this, he was with Progressive Insurance Berhad, Affin Fund Management Berhad, and Areka Capital Sanjam Berhad. He has more than 10 years of experience in the capital market industry. He graduated with a Master of Science in Finance and Bachelor degree in Finance from University of Udara, Malaysia, UUM. He is also a license holder of Capital Market and Services Representative. Our final panelist today is Kim Chor. He's an investment specialist at Phillip Capital Malaysia. He has over 5 years of experience in the financial industry, mainly in the stockbroking, equity capital market, and investment banking fields with stints at MITF Amanah Investment Bank Berhad and CAF Equities Sdn Berhad. He has serviced institutional clients and foreign funds by product macro research, trading ideas, market commentary, and analysis for Malaysian equities in his previous role as a stockbroker. He holds a first-class degree honor in accounting and finance from University of Warwick, United Kingdom. Together, our panelists will explore the key differences between growth and values investing and discuss the advantages and disadvantages of each. We hope to gain valuable insight into these investing strategies and provide our audience with a better understanding of which approach may better suited for their investment goal. So, without further ado, let us start with the first questions, and probably we can take it as an introduction questions. What are the key differences between growth and value investing strategies, and what are your preferred set of rules to differentiate between growth and value? Chris, would you like to start first?
Yeah, just to start very simply, what exactly is value? To give you a simpler example of what value is, if you buy a one-seater car for 50,000 ringgit and you buy a five-seater car for 60,000 ringgit, how much are you paying for one seat in a car? So is it worth buying a 60,000 ringgit car for 5 seats or one seat car for 50,000? So it may seem cheaper to buy a 50,000 ringgit car, but the 60,000 ringgit car, which is more expensive, has more value. So value in investing is something like buying a 5-seater car for 60,000, even though the price point is more expensive. So in the world of investment, we tend to look at certain valuation matrices. So we take the book value of a company. Stock issuers have book value. Okay, we compare against the price. We look at the earnings, for example. We compare against the price. And we ask ourselves, what is the value we are paying for the earnings and for the book? If that comes out to a good value, then we'll pay and buy the stock. Growth tends to look at earnings momentum and tend to look at paying for the growth regardless of the price. So I would tend to see these two differences as one is particularly very focused on the growth prospects of a company, whereas the other one is very attentive to how much value you can get for paying for the investments.
Okay, great to hear that. Ivan, would you like to share something on what's your view on growth versus value?
You're wonderful, Ivan. But first and foremost, thank you so much for inviting us to join for this section. I think it's our honor here to be today. So just give you some illustration for the growth and also the value for the bond investing, because bond investing and equity definitely is from two different instruments. So for growth, I think from the bonds perspective that we are looking at will be likely on the rating revision. For instance, let's say that they have a potential upgrade or outlook positive, and in the event that this so-called underlying instrument itself they have a potential upgrade or outlook positive, then the yield itself will be compressed, and hence that the underlying bond price will be improved, and definitely it will be good for the bond fund performance. On another hand, in the event that we are talking about a value bond itself, probably we can say that maybe a certain bond is trading at discount, which actually will be against with the benchmark for the yield curve. So as an active fund manager, we always can find some jam during the thin traded volume or sell-off market, and it requires a lot of patience and determination to do a bond trading. And this type of the bond trading basically will be trade over the counter, and therefore I think it requires a high level of acquisition still with the bank dealers. That is my understanding or some sharing from the bond perspective.
Yeah, thanks, Ivan. Kim, how about you?
Okay, thank you so much, Chris and Ivan, for the explanation. Chris actually used a very good example in illustrating the difference between growth and value investing. So basically, our opinion is that whether or not growth and value is a more suitable investing strategy, it ultimately depends on investment objectives of the investors, valuation and risk tolerance. If we are looking at value company, I think some of the key metrics that we can look at value and growth is by using maybe some financial metrics like PE, PB, revenue growth, as well as dividend. If we look at some of the companies, some of the value investing tend to demonstrate lower PE, lower PB, more steady revenue growth, as well as relatively higher dividend yield, and vice versa for growth investing. Ultimately, growth investors, they are willing to pay a higher price for companies with a better growth potential, while value investors, they are looking for company, they are trading at a discount to their intrinsic value. One good example that I can relate is that would you rather buy a Mercedes-Benz at 70,000 or X70 at 50,000 ringgit Malaysia, for example? We all know that luxury cars like Merc, if they are selling at 70,000, is actually at a very huge discount, and that's where we see value from it. Okay, I'll pass back the floor to Weiler.
Yeah, thanks, Kim. Well, since we talk about some variation metrics like the P and PB, do you have some rule of thumbs on how low should a PE be to be called a value, and how high a PE, or we can call it for PE that you call it a growth? Chris, do you have a set of rules for this?
The set of rules are relative. I say this because if you look globally and regionally closer to home, we can still find stocks that trade 3 to 4 times multiple, price earnings multiple.
Yeah.
But are they performing as a stock? Not necessarily. Are they cheap? Are they good value? The answer is yes. So the rule of thumb does vary according to market conditions, the sector they operate in, and how you do your cross-market or cross-sector comparisons. So you can say consumer discretionary like a brewer in North Asia, they can trade at 25 times multiple, but the stock price can move 10 to 20%. But where is the value? The value of a brewer, if you look across the region, is closer to home, Malaysia, where our brewers are trading cheaper in valuation terms, but the price performance may not be as compelling. So sometimes it awaits the catalyst, the discovery, and certainly we've seen it recently that the Malaysian brewers are starting to perform because they have a combination of valuation as well as dividend yield.
Okay, thanks, Chris. So if there's different variations on the same variation metrics like PE, what makes it different that some region will deserve a higher variation and some regions will deserve a lower variation? What do you think about this?
It probably will be depends on the several sector, which I think at the moment I'm thinking that probably will be a liquidity and also the market cap for a certain country itself. For instance, I think Hong Kong. I think talking about the Hong Kong stock market, I think definitely in terms of market cap will be bigger compared with Malaysia. And hence a lot of listed company when they do for IPO, they tend to go for this so-called Hong Kong, especially from the technology company, as well as the NYSE or Nasdaq for tech shares. I mean the good example with the Alibaba. I mean one of the reasons why they go for this so-called US market to do a listing because of valuation and also because of the high PE, and therefore they can demand for a better valuation for the company itself.
All right, thanks, Ivan. So I think that's a pretty good introduction on what we call growth and what we call value. Here comes our second question. Since late 2020, Weather has been outperforming growth. However, this outperformance only arrived after a decade of underperformance. Can you elaborate on the factors that caused the change, and do you think the value will continue similar trend in 2023? Kim, what do you think about this?
Thank you, Weiler, for the questions. Growth stocks have been outperforming value in the past under a low interest rate environment. Growth companies, they tend to expand more aggressively, and low interest rate does help a lot because their borrowing costs can be lower and cheaper. If we are looking at the United States itself, as Fed turned more hawkish, especially last year in their monetary policies to combat against inflation, rising inflation and interest rates have been benefiting value stocks, as value stocks are less sensitive to interest rate movements than growth stocks. But of course, I think it's also important to note that the performance of value and growth can be very cyclical, and there may be times where growth stocks can actually outperform value stocks and vice versa.
So do you think the trend that value outperform the growth will continue in 2023? Because we know from the market trading, we know that probably Fed will be reducing the rate this year.
Yes, in 2022, we see value outperform growth mainly because in high interest rate environment and high inflation environment, value companies can be more defensive. But if there's an expectation that the interest rate can trend lower, and in fact, actually, if we look at the recent interest rate movement, market is starting to price in more than 100 bips rate cut by end of this year. I think this should be beneficial to the growth companies because if you look at the interest rate itself is lower, hence their borrowing costs can be lower as well. And this will also improve the valuation.
Yeah, thanks,
wonderful.
Kim.
I think I just want to add on, I think I agree with Kim also. I think if we look at the Nasdaq counter, I think some of the technology share itself, which is defined by the value, so-called value segment itself, I think in terms of growth for year to date, they are quite fantastic in terms of rebound. I think double-digit gain, I think, for value company or tech stock, I think mainly in Nasdaq.
My perspective on growth versus value, the first starting point, before we talk about growth versus value per se, let us appreciate what goes into the constituent of MSCI World Value, MSCI World Growth. If I look at the values index and MSCI, the key sectors in the top 10 holdings: healthcare, energy, staples, communications. The top 10 sector in the growth segment is consumer discretionary, communications services, i.e. e-commerce, social media, technology, and which can be related to EV, for example. So when we appreciate the last 10 years, for example, and we look at globally how technology has shifted, just using a phone, for example, Samsung Galaxy 2, 3, move on to 5, 6, then Note 10, now S20, 21, 22, 23, whichever. Okay, so the advent of technology, the advent of e-commerce, and then the rise of China in the last 10 to 12 years suddenly awoken people's curiosity on growth potential. So the Koreans, the Taiwanese, the Chinese, the Americans all came out with their respective growth sectors. So if you look at the point where they started to emerge, which is after the global financial crisis, it also came about the quantitative easing, 1, 2, 3. That flowed on to maybe the later part of the 2010s before the US started to shrink its balance sheet. But the era of easy money and the discovery of a lot of growth, earnings growth potential, meant that there was a lot of flight to these growth-centric sectors. So that has led the growth index to outperform up to 2020. We're looking at 2021, peaked in early 21, going to 2022, value started emerging. And there's good reason why value emerged in the last 2 years. Firstly, valuation-wise, people start to wonder, why is this stock trading at 5 times or 10 times versus an e-commerce trading at 40 times? And then, what are these value sectors in? They are in energy, they're in commodities, and they start to wonder with the Russia-Ukraine war, crunch in commodity supply, energy sectors went through crunch, commodity prices went up the roof. What happens to energy and commodity producers? They started to amass big amounts of earnings, but because they operate in mature sectors, what happens to these earnings that they've generated? The outlook for value then turns into capital repayment, earnings distribution via dividends. Then they became dividend high yielders, and they became very, very attractive, and value this therefore did very, very well. But interesting to note, if you come to the first 2 months of this year, and certainly to the bit of March, MSCI growth year to date is now 11% positive, and MSCI value is minus 2%. Interesting. And comparatively in Asia, growth minus 0.3%, value positive 0.7% so far. And what's important is to look forward. What are the drivers in the economy? What are drivers in the sector? And what is driving stock earnings going forward? Would then value stack up well against growth, or will growth outpace value this year? So we start by talking about the underlying sectors behind value and underlying sectors behind growth.
Yeah, thanks, Chris. That's really a clear explanation. So, Chris, do you think this outperformance of value will continue this year? As you know, the Fed is going to reduce the rate. So probably the outperformance year to date this year of growth stock is because of the expectation on that?
We start with the high level view. what potentially could be the catalyst for growth and what would be the catalyst for value. Okay, if we believe that the US S&P 500 year to date October 2022, which was a minus 25% year to date as of mid 2022, October 2022, if we believe that has already priced in a mild US recession, and there are some recession studies done in the US market that allude to that, then the equity markets drawdown last year has already factored in a mild US recession. Let's look at the US outlook for 2023. Last year, if you were to think, what will the US grow this year? Consensus would say 2.5%. More recently, now that we are in year 2023, if you ask the private economists, consensus would therefore say the US economy will only grow 0.8%. Now that is a very sharp downgrade in growth expectations. And this comes amidst rising interest rates. And it does not take very much if the US continues to be very aggressive to tilt the US into a mild recession. But has that been factored in? The US market does suggest that it's already factored in. So the way forward is to say, if we are entering into potentially a mild recession condition, what then could happen? Would they adjust interest rates expectation? I think some of the discussion points going forward, we're going to be talking about that one. What then happens to the economy? Would it recover? Would it resuscitate? What is the implication for growth assets? Okay, if the trajectory starts to happen again, let's not look at 2023, let's look at 2024. If growth resumes 2024, stock prices should start to reflect 2024, not what could potentially happen in 2023. That would give a context, and I wouldn't be inclined to think if you were to look that far ahead, I would say growth will outpace value.
All right, thanks, Chris. It's really clear. So oftentimes, we hear about growth and value and equity. In your opinion, do growth and value exist in fixed income, Ivan?
Certainly, yes. I think like what I explained earlier on, I think that for this growth in bond itself or fixed income itself will be mainly for the rating revision. So in the event, let's say that we buy into a AA3 bond, and once that the bond has been upgraded to AA2, and hence the yield has been compressed, and it will be jumped in terms of a bond price itself will be good for the bond performance. For value bond investing is that a fund manager required to find a gem or to find a bond that is trading far below the average benchmark, so that we are trying to get some sort of like discount instruments that far away from their intrinsic value. But nevertheless, I think it will be very difficult to explain in the layman's, because most of the time that we talk about a value investment as well as a growth investment will be mainly from the equity perspective rather than the fixed income perspective.
All right, thanks, Ivan. So 2022 is a unique year where both equities and bonds suffer huge losses. Do you think 2023, which is this year, will exhibit similar trend? How should we allocate our exposure on various asset classes this year? Kim, we're happy if you can take this question.
Okay, thank you, Weiler. I came across an article that says that if we look at the 24-month rolling correlation between the S&P 500 and the US 10-year, the correlation actually swung up and down over the period. Before 1995, both asset classes were moving in the same direction, because at that time, for example, in the US economies is generally featuring high growth with sustained inflation. But since then, to the early part of pandemic, deflation was more of a risk than inflation, and that trend promotes diversification benefit between stocks and bonds. But in 2022, a period of high inflation, we see both equities and bonds, they are moving in tandem again, and the correlation coefficient even spiked up to 50%. But our opinion is that in 2023, bonds and equities will be moving less in tandem this year because equities are seeing drop in earnings expectation because of some recession risk, but bonds are seeing attractive yield. And that diversification benefit will actually work well under a lower inflation regime this year.
So can I say you are a little bit overweight on bond than the equity?
I think a balanced fund should be fine.
So it's a 60-40 or 50-50?
Yes.
All right, thanks, Kim. Chris, what do you think about this?
I think this will be a good year for both bonds and equities, but between these two, I will favor equities. Just use a rule where you inverse the price earning. Price divided by earnings, inverse it, it will become earnings divided by price. We call this earnings yield. Take earnings yield minus the bond yield. You can take a government bond yield and then ask yourself, is there sufficient difference in these two yields? If the yield in earnings is higher than the yield in bonds, then we will favor earnings, which is equities. So let's say KLCI price earning ratio is 14. If you reverse that, then it will give you 7%. What is the 10-year government bond yield? Roughly 4%, I think. So 7 minus 4 equals 3. Then we ask ourselves, which one gives you more value between these two asset classes? Earnings yield. So therefore, I would favor equities versus bond. The challenge is, will bond yields go higher? If it does, then the yield spread will compress and therefore stock prices will come down. But if you take the view that either bond yields stay as it is and earnings grow, or bond yields fall, then the difference between earnings yield and bond yield widen. Then it makes earnings yield even more attractive. Okay, so while I believe there's room for both asset classes to grow, why? Because bond yields are coming off and short-term yields are quite elevated, right? So if you construct a fixed income portfolio, you can get, if you're using a barbell strategy, maybe a running yield of roughly about 5% gross, right? But if you invest well and you're a stock picker, you will not buy something that is potentially earning maybe only 14 times multiples. Let's say you can get even better value in your stock picking. Then your yield spread is a lot better. So in a well-constructed equity portfolio, it will tend to outperform the bond portfolio. And I think this will be a good year for equities.
All right, then, Chris. So, Ivan, as the Fed prepares to cut rate later this year, the US long-term treasury is poised to benefit. What are the other fixed income that we should focus on this year other than treasury?
Wyvern, I think I just want to add on, on what Chris just now been mentioned, I think on your previous question. I think just want to add on a little bit, I think like what, I agree with what Chris is saying, but to my understanding, I think, back to your question again just now, I think the most important will be the investor risk profiling and also their investment objective. Some certain degree itself, for instance, I think the institutional investor probably will shy away from investing into the equity. So with that, I think probably this will be a good time to do a bond investment on the long-term horizon. But I don't deny that stock picking definitely, I mean, if a sharp, good fund manager with a quality or stock picking, maybe they can generate an alpha return compared with the bond investment. But to further add on, I think timing is another strategy that I think require a sophisticated skill in order to perfect or to double increase that alpha return for that. Yeah. So yeah, I think just now you asked me pertaining on the long the preparation for what are the other fixed income that you should focus, right?
Yeah.
I think you are right. I think the Fed rate hike almost stoppish. That is our internal view as well. Early on, we think that maybe potential rate cut into second half of 2024, but right now because of the so-called banking financial crisis in US, so we bring forward to first half 2024. So to answer you, beside the fixed income, I'm thinking that probably for sophisticated investors, maybe they can consider a franc with a high strike price and also high coupon. But the only concern will be the reinvestment risk for the current investor. And also, in the event that, let's say, recession is coming in, the bank has the right to call, and so they were facing a reinvestment risk for this product, which is recurrent approval.
All right, thanks, Ivan. Here comes the next question. How do you balance between short-term versus long-term investment horizons when making investment decisions? Many people have this perception that growth is related to short-term and then value is always linked to long-term. Can we argue on this topic, Kim?
Okay, I think Ivan has the point that ultimately whether what kind of investment is more suitable for the investors is depending on the investor's investment goal and objectives. I think risk tolerance and time horizon could be among the key considerations. So short-term and long-term ultimately is also depending on the investor's preference and objectives. And ultimately, investors should look at the investment strategy, the appropriate ones that fits into their investment profile. The common perception growth is related to short-term, value is long-term. I don't think it's true because I think if we are looking at the equities, growth stocks can still be long-term investment as can value stocks. And growth stocks are typically the companies that can grow faster than the market, and value stocks are undervalued companies compared to the intrinsic value. So I think both stocks, they value and growth, they can also have the short-term and long-term potential. But yeah, ultimately it also depends on the investor's investment goal. Hence, a well-diversified portfolio contain a mix of short-term and long-term investment value and growth is important to balance the risk and return.
Yeah, so it really depends on the risk appetite of the investor.
Yes.
Yeah. So, Chris, I believe many retailers, right, it's really very short-term views have a short-term views on equity. Can you advise on how can we change that perspective so that we can hold on to the stocks longer term?
For retail investors subscribing to unit trust fund, please appreciate that you are on a long journey. Think of it as traveling from Penang to Singapore by car. Sometimes the fund manager will stop for petrol. Sometimes we'll stop for a snack. We'll rest a little bit. But we appreciate that sometimes there's also traffic. There's also pothole. So we drive fast sometimes we drive a bit slower. We try to stay within the investment parameters, which is called the speed limit. With 110 kilometers. We stay within the boundaries, don't get in trouble, right? But appreciate that sometimes it rains, Like in the investment climate right now, it's raining. Sometimes it's drizzling, sometimes it's thunderstorm, sometimes it's hailstorm. Okay, so it's important that when we adjust the portfolio, we are doing it for the best interest for the client. But don't forget, the client is on a long journey from Penang to Singapore. But the driver of the car, who is the fund manager, sometimes need to take a stop. So we may, from time to time, move on to value sectors. Move for some utilities, get some dividends, right? Maybe we construct something. We see a growth opportunity in technology. We add some technology. Maybe commodities are doing well, so add some commodities. Overlay that with growth. So a well-balanced portfolio need not necessarily be pure value or pure growth. We'll take the journey for the investors. So investors, remember, you are journeying from Penang to Singapore. We are stopping by here and there, and sometimes we are driving fast, sometimes we are driving slow.
Thanks, Chris. Yeah, in investment, we always talk about long term, so that we can achieve, the final goal objective that we want to achieve. So, Ivan, how do you, stay focused on long term and, when there's short term fluctuations and there are short term hype, how do you get yourself, something like aware of the current situation and do not make a mistake on following the hype?
Yeah, I think good question. I think Waylon, yeah, but I think thank you so much, Chris, for the story. I think I like the story just now that you tell that. Yeah, investor is supposed to be travel from Penang to Singapore, etc., etc. But to answer you, I think to answer, one second. I think to answer Waylon, I think most of the time that when we share with the investor, we told them that investing into a bond fund is a long-term investment horizon. At least you need to have a investment horizon for minimum 3 years in order for you to see some sort of like stable return. And when we talk about a stable return, that we are aiming between 4% to 6%, that will be our targeted return. So in the event that return is more than 6%, somehow they will make it, but that is considered a super good year, which was, I think, happened in 2019 also 2020. But nevertheless, investors also need to understand that if they require a higher return itself, ultimately the fund manager will require to deploy a slightly risky investment strategy. No doubt to say that at the end of the day, we are dealing with all kind of risk, and then risk trade-off is always playing a very important. And talking about bond investment or bond fund itself, I think our key concern will be mainly for the interest rate sensitivity, which will require whether a fund manager should add on the duration or reduce the duration. Another key risk consideration will be mainly for the credit risk. So therefore, to diversify the credit risk will be a few items, which I think one of them will be a good quality paper that we select, that we need to actively engage with all the corporate issuers. And another one will be the diversification, that which we have a cap. I mean, internally we have a certain cap, so that we won't 100% go into a one certain degree of the bonds. Like I think what happened, I think in last week, that I think some of the wholesale bond, they are suffered because of the single bond exposure into their wholesale trust fund.
Yeah, thanks, Ivan. Kim, can we actually implement both growth and value strategies in one portfolio, and how can we do that?
I think it's possible to implement both growth and value strategies. Ultimately, it also, like what we say earlier, it depends on the investors' investment objectives. Ultimately, also depends on their risk profile, time horizon as well. I think one good way for investors to implement these strategies together is that, for example, if you have 1,000 ringgit, and then perhaps you can actually divide this 1,000 ringgit to two different sections. One section to invest in growth stocks, and another section to invest in value stocks. But of course, if we are looking at equities, the barrier of entry is actually relatively higher, because if we look at, let's say, if you are trading on Bursa Malaysia, if you are buying one lot of Maybank at 850, the cost of investment is 850. That's why another alternative to equities is to invest into unit trusts, or maybe mutual funds, ETFs that focus on growth or value stocks.
All right, thanks, Kim. Yeah, we have one questions from the floor. So we know that KLCI has been trading range bound, for quite some year, probably almost 1 decade already. So this is a contrast difference as compared to some of the developed market that yielded very attractive return over years. So if I'm to stay in Malaysia to continue invest in Malaysia, how can I improve my performance, over the years? Chris, would you like to take that questions?
Yes, I will correct the perception that the KLCI is going nowhere. It is correct if we just focus on the price of KLCI. But if you focus on KLCI as a total return, and you do a 20-year study, and from that 20-year study, each year has 12 months, 12 data points times 20 years. And if you compound that over the last 20 years, the KLCI actually delivered 8% per annum return. How is that possible if the price is going sideways, if not lower? It's because the KLCI has matured from an Asian tiger in the 90s to a very mature market. Underlying blue chips, top 30, they change, they rebalance. But they are also becoming not necessarily very growth-centric, but they have certainly become very dividend-centric. So if you reinvest just within the KLCI constituents and you stay compounded over the last 20 years, allow the index rebalancing to shift it, you would have returned 8% per annum. That is the perception I'd like to address, that Malaysia is not an investable market. Actually, it is very investable.
All right, thanks, Chris. Ivan, we have been talking about equity. So can you shed some light on how the bond market in Malaysia looks like, how the performance as compared to peers or our neighboring countries? Do you see, do we really have that edge as compared to the other countries as far as bond is concerned? Yes, Ivan.
Yes, thank you, Violen. I think we have the edge. I mean, for instance, I think for the bond fund that we manage in-house, which is the Amanah Raya Sharia Trust Fund, during the COVID time, I think this particular bond fund that we managed in-house for the RM, we are outperformed compared with a lot of the peers. I still remember that I think in 2019, we closed almost 11%. A single year itself, bond fund, 11% return is far higher compared with our targeted return, which is 4 to 6%. So 6% on the top page, it means that 11 is outshined by almost 500 basic points. And then in 2020, this particular bond fund also continued to perform. I think we closed at about 10%. So with that, we can conclude that for local market itself, local bond itself, if we doing, I think we can easily, or we can demonstrate that we are proven that we can do well compared with the regional, compared with the peer.
Yeah, that's
I
really
hope that
Yeah, thanks, Ivan. Okay, so I think it is appropriate that we talk about a little bit about the recent development in the financial market. We know there's a bank run in US, and Credit Suisse has come, as you know, has been bought by UBS. Of course, it faced some problems there. So in view of the recent collapse of SVB and the Signature Bank, what's your view on the impacts to the local banks as well as the regional financial sector? Would it possible for the similar events to happen in Malaysia or our neighboring countries? Kim, would you like to take the question?
Yeah, sure. Maybe Mr. Chris and Ivan can chip in later. If we look at SBB, for example, it's a banker to US tech companies and startups. If we look at the client profile, nearly 50% are US tech and life science company, and 44% are US tech and healthcare IPO companies. And SVB is actually a beneficiary of the pandemic tech boom, whereby we see the deposits triple just in 3 years' time from 2019 to 2022. But the two key challenges that SVB was facing is that the Fed has been rising the interest rate very aggressively, and also as a result of that, we see among SVB clients, we see a higher cash burn rate among the clients, and the startup companies need to withdraw deposits to stay afloat. We don't think the recent SVB fallout will apply to Malaysia Bank, mainly because of few reasons. First and foremost, in Malaysia, the interest rate have not risen as dramatically as in the US. We only increased, I think, 100 bips since May 2022 versus 450 bips in the US. Hence, if we look at the bank's portfolio, the mark-to-market losses have not been as heavy as the US banks. And maybe secondly, if we look at the client profile itself, Malaysia banks have relatively stable depositor base, mainly household. So we don't face the cash burn issues that the SVB tech depositors are facing. And if we look at Malaysia deposits as well, I think 65% are long-term deposits. Short-term is just 35% of the total deposits. So it's harder to withdraw in the event of a bank round. So maybe Mr. Chris and Ivan can top up on top of that.
Yeah, thanks, Kim. Let me add to that the failure of Silicon Valley Bank partly also is premised on how they run the bank, not just from a deposit standpoint, but what do they do with the deposit after they collected it. Let me share some numbers with you. Silicon Valley Bank had roughly US 210 billion in assets. Over 70% were held by corporate institutions, like what Kim has mentioned. So the deposits tend to be very chunky. Compare against Asian banks and Malaysian banks, where culturally we are naturally very high savers. So the retail deposit becomes the anchor for our banks, Malaysia and regionally speaking. So once a big corporate comes and place big money into a Malaysian bank, and if it starts to feature very big in the deposit structure of a bank, right, rest assured our central bank will come knocking on the door. Okay, so the failure of Silicon Valley is because it didn't really fall within jurisdiction. I remember watching an interview where Trump actually liberalized that so that these tech startups, tech-driven banks, can actually run their own show. So what happens in running that show? They took the depositors' money and placed almost 60% of the assets, roughly 120 billion for Silicon Valley, into securities. Now, what business does a bank got to do taking depositors' money and buying securities? Aren't they supposed to be lending out? And they're supposed to be a lender, what a bank is supposed to be, but they became a leverage fund manager. I take a deposit, I pay you an interest, but I bought investment securities. The investment securities, not an issue if you don't market to market, but when they start to withdraw money, they are expected to liquidate the securities. That's when they start liquidating the securities at a loss. That's when they realize they don't have enough money to pay, and therefore they fail. Comparatively speaking, if you look at the big banks in the US, roughly only 1/3 of their portfolio are in investment securities, either available for sale or held to maturity. In Malaysia, one of our main banks, only 25%. So in comparison, we tend to be in a better footing. One, because of retail deposit base, which is sizable, and secondly, the exposure to those assets are lesser, because primarily we operate as a lender, not an investor.
Thank you, Chris. I think probably I can add in also. I think SVB bank failure, I think, is an unfortunate event. I think part and parcel because the duration risk management that they deployed is wrongful. And I think thank you so much, I think, to the Bank of Government Malaysia initiative and also the strong financial system. I think we have a lot of Basel requirement also, the car being imposed. So I think locally itself, I think Malaysia, we have a very, very strong fundamental banks. So with that, they will have a very, very low possibility that I think Malaysia Bank will become like SVB Bank. But nevertheless, I would like to emphasize that because of the recent sell down of the banking stock, probably it will be a good opportunity for equity investor to consider a banking stock. But in the meantime, because of this thing happen, it will trigger the necessary for the Fed to bring forward the rate cut. So it will, in the meantime, also beneficial for whether equity investor or bond investor on a long-term basis.
But this is where I would partly differ from being too much emphasis on banking stocks, because firstly, the rate hike cycle potentially is coming to an end, if not already ended, or at least a pause. So the expansion in the net interest income, which is the bank's one of the core bread and butter revenues, is going to taper off. The expansionary mode would have ended. And then when we look into, let's say, a moderating economic cycle, especially coming into this year, potentially loans growth could also be tailing off a little bit. So in any case, if the bank stocks do throw up some interesting value, let's say because of market volatility, then yes. But I think as a growth potential, I think other sectors would be more appealing compared to banks. There's only one.
What about
Sorry.
What about a European banking stock? Do you think it's cheap enough for the valuation per se?
I would tend to look into China banks as the next.
Something.
Why? Because the China term structure of interest rates suggests a rise in interest rates going into next year, because they are the latecomer in reopening the economy. The bank's valuations are very cheap. They're high dividend yielders, and they're coming off from a low base. So if they are on the late rate hike cycle trajectory, then they will be the next ones to benefit from potentially hikes in China rates. So that potentially is a 2024, 2025 story.
Interesting, Chris. Yeah. Back to you, Wylun.
Sorry, I think I can't hear. Yeah.
While we wait for our host, maybe I can add some more color from Asia Pacific banks. Just lifting off a study of about 100 banks studied by a foreign broker. So I claim no credit to this research, but to share some idea on how they actually stress test the banks on their holdings in the securities which they hold. Taking the example of Silicon Valley Bank. What happens if you take the held to maturity securities? Because normally a bank, when they buy some of these securities, they hold it to maturity, so they don't actually mark it to market. So you actually don't show the fluctuation in the prices in the books. But one broker has taken the trouble to stress it across these Asian banks. And they found that of the 99 which they have researched, one may potentially trigger a sharp move in their capital adequacy. I know it's a bit technical to talk about capital adequacy here, but essentially, if a bank is supposed to maintain a certain amount of capital beyond a certain threshold, then it would raise some alarm bells, and they would require additional capital to prevent the bank from going under. So of the 99, indicatively, if the stress comes, one will feature in Asia.
All right, thanks, Chris.
That's an interesting outcome from this book.
Yeah, so sorry. Can everyone hear me now?
Yes, Wylun can.
Yeah, thanks. I ran into technical issues.
No problem.
So, yeah, I would like to extend one question from the SVB case. So do you think there will be possibility that this thing develop into a more serious financial crisis moving forward? Yeah.
One of the stopgap has, in the last 10-ish years, has been the introduction of Basel compliant bonds globally. Systemically important banks globally have issued loss absorption bonds. I think we have all been reading about we're all getting a very fast-track education on this AT1 bonds, so additional tier 1 bonds. But let me just simplify for our audience here. Arising from the global financial crisis, regulators, central banks, governments started to bail out the banks because they went into trouble because of their business deals, the kind of products that they were offering. And to prevent further bailouts, that means it's actually cost to the government, it's cost to shareholders. They've now moved the banks to issue contingent convertible bonds, which means that if there's a crisis and if certain conditions are met, the bonds can actually be converted to equity. Then that shores up the equity base of the banks, and that puts them back on a better footing. Okay, so there's been a lot of issuances of this, but primarily by the European banks, by the global banks, US global banks, for example. So many of them have issued that. So the blowout in Credit Suisse recently, in that sense, it doesn't really surprise me because they've issued quite a number of these contingent convertible bonds. But it surprises me to read that some fund managers are jumping up and down and say, why is this happening? To me, it's actually very clear in the prospectuses of the bonds that should this happen, they can actually claim on the bond, forfeit it, and convert it to shares. Or in some cases, they just don't pay back. Okay, so many banks are buffered arising from this additional tier 1 capital.
Yeah, Ivan and Kim, do you have anything to add?
Yeah, I think, Wylan, I just want to add on your question just now. I think to my understanding, I think with Yellen, I think yesterday also voiced up her opinion to say that they will try to rescue all the banks in US. And with that, I think First Republic Bank also yesterday rebound close to 30% within a single day. So for my opinion itself, I think that quality offshore AT1 bonds probably with an attractive yield, I think investor can be considered. But nevertheless, as for RM itself, we have a zero exposure into all these AT1 bonds for time being. And I think at the moment in the near term, we also won't have any so-called foreign bonds investment. But if you ask me personally, I think that quality offshore AT1 bonds with attractive yield is a good, investor can consider for a longer term per se.
Yeah, let me add to that why maybe it's a contagion or the defaults of all these bonds, quote unquote, will not reach the Malaysian especially, and also to some extent the regional. Let's talk about investment profile. Let's say an insurance company, when they buy bonds, typically when they buy bonds, this is one category of investment that they're not particularly heavy on, if any at all. The emphasis is usually on government, quasi-government, very strongly rated secured bonds. So subordinated bond space is not really a space that they are in. Okay, so they're lighter on that. So would there be a significant impact on insurance companies? No. Secondly is, usually these bonds are denominated in offshore currencies. So say, for example, dollar, euro. In Singapore, there are some contingent convertible bonds. But can a Malaysian insurer buy it? Usually, no. They have some small allocation for offshore investments. But in the interest of asset and liability matching insurance company, they will match similar liabilities, which is the insurance premium payers, which is liability in ringgit, with a natural currency, which is also a ringgit asset. So match ringgit asset with ringgit liabilities. So unlikely they go offshore to buy this kind of instruments. So by default, so they won't have, if any, exposure to this kind of bonds. And then banks typically, when they buy into another bond, risk management perspective usually constrains them. So they tend to be either more domestic currency bonds, any offshore ones, they probably buy maybe some treasuries, but unlikely to go into that kind of subordinated structures.
All right, that's really clear. So on one hand, we have inflation issues, and then now the bank run is, just started to ease. So all this is causing the consensus, or the market trading terminal rate to fall from a peak of 5.75 to now just 5% or 5.25%, and the rate cut will follow sooner than it was expected before. So what is your view on this? Do you think as the inflation that's claimed by the Fed that's still high, do you think it will run into a more problematic inflationary problems in the future? Yeah, Kim.
I think because of the recent fallout in SVB, inflation risk is likely like yesterday's story, because Fed can now refocus from the inflationary risk to financial stability risk. I think a lot market participants are arguing that the so-called recent SVB fallout is a liquidity crunch rather than a credit crisis. But our opinion is that if the current liquidity crisis transitions into the credit crunch, which would happen with the increase in the bad loans, we could be facing a deflationary depression. That's why we are seeing the market is now pricing in like a lower so-called terminal rate, or even like more than 100 bips rate cut by end of this year. And now Fed has actually an incentive to avoid recession by controlling the so-called monetary policies, since the recession would increase the probability of a credit crunch. And if we see Fed is going to pivot, if we were to link back today's theme, growth versus value, growth stocks are particularly sensitive to interest rate, given the long duration of the expected cash flows. And hence, the so-called pivot could actually benefit growth investing.
Yep, thanks, Kim. Ivan or Chris, do you have something to add on regarding these questions?
The trajectory does suggest it will pick up at 5%. I do acknowledge that at some point recently, it was as high as 5.75. So the market implied rate, as suggested by the futures market, is pointing towards 5% in about 6 months' time. But really, it's anyone's guess how the Fed will interpret the fallout of the Silicon Valley versus fighting inflation with interest rates. Okay, so I'm more interested in the trajectory of the rates. Are they peaking? Are they on a downward trajectory? If you look into the futures market, it suggests 1 year out, the trajectory is downward sloping. So rather than fix on, is it 25, is it 50, I will focus on the trajectory 1 year ahead. Because if you invest in equities, we take that forward view. The forward view is crucial. So, and given that the US economy is on a very delicate balance between mild growth and mild recession at this point, any further aggressive hike, higher for longer, this is a catchphrase by the way, could actually tilt the US economy to recession. At some point, they're going to acknowledge they probably have done too much, and therefore they may have to start cutting. And history has suggested once they cut, they can be quite aggressive in cutting. And then when that happens, risk assets will be flying.
All right, thanks, Chris. And back to home, PNM has not hiked rate in both January and March MPC meeting, but as the market widely expected, there will be at least one rate hike of 25 basis points by PNM this year. What is your view on this, and what will be the impact to the local fixed income environment? Is PNM hike or not hike the rate in the near term? Ivan?
Thank you, Phillip. Thank you, Phillip, for this question. I think we are in our aim. Actually, I think we are same view with the market consensus that we believe that they will have a potential one-time rate hike, which will bring the OPL from 2.75 to 3%. I think in terms of timing, I think internally we are looking at May 2023 this year. And I think one of the reasons that why the Bank of Ghana need to increase the interest rate partially because of the interest rate parity between the US and also in order to support the ringgit. But nevertheless, we saw that market has been pricing in the rate hike, and I think ultimately it will be good for bond investor, especially we are talking about the rate hike every time. So at least that once that the Bank of Ghana betul-betul go and do the rate hike, it will clear the uncertainty, which in my opinion, I think it will be overhaul, will be good for the bond market, bond investor. We will have a certainty from uncertainty to become a certainty. I think with that, it will be good news to the bond market, bond investor as well.
Interested to note that the 10-year Malaysian government securities last year peaked at about 4.6%. And if you think that rates are going to even go up further this year, why is it today trading at 4%? Should it not be higher? So what is the bond market really telling us? Slowdown in the economy, pause in rate hikes. So really the bond market is ahead of policy rates. So again, I will also tend to look forward to the trajectory of where Negara is going to be if, say, even if they do a 25 basis. So the real question is, what next after this 25? Pause. If the US is not going to be aggressive any further, and there's really no need to defend the ringgit, for example, by raising more rates, then a pause could be the answer. And the bond use could fall. Bond price will go up, and therefore bond funds will be performing.
All right, thanks, Chris. So I think we dedicate the last questions to broad questions. What are some of the key trends that you see emerging in the global equities and fixed income market, particularly with respect to growth and value investing? And how do you think these trends will impact the investment opportunity in the years ahead? So these are very broad questions. Kim, would you like to answer these questions? Yeah, you can break it down into a few sessions like global equity and fixed income one side.
Yeah, I think we can just let this be an open-ended discussion. Allow me to start first. I think since 2020, where we see investors are working from home, they have more time to look at the market. Market has become more efficient with the help of the gadget, the information flows. A lot of informations are shared on the social media, Telegram groups and whatnot. So I think in years to come, we believe that market should become more and more efficient, and this should actually be beneficial to the investors because if we believe that the market is efficient, then the share price, if we look at the equities market, the share price will tend to do well. So opportunities that we see ahead actually not only from value or growth investing perspective. I think ESG investments is also a very important segment that investors are looking at. We are seeing ESG investing is getting more and more traction from the institutions, from corporates, individuals as well. That's why we see a lot fund houses, they are launching ESG related funds to cater the needs for the investors. Yeah. Looking at the fixed income perspective, we also see that there are also a lot ESG related sukuk that have been the so-called green sukuk that have been available in the market, and even recently Bursa is also working with some other parties to work on the carbon market as well. So I think in years to come, there are more and more opportunities that investors can capitalize, but ultimately, whatever instruments that investors are investing in, it should be aligned back to their investment objectives as well as their investment goals and time horizon as well. And ultimately, investors should also be doing some due diligence, consulting with professional financial consultant, professional asset managers when it comes to any investment decision making. Yep, maybe Chris and Ivan can add on to that.
Thank you. There are two main pivots we're looking at as a central theme to regional investments. That's premised on the interest rates in the US. What happens when interest rates peak? The dollar strength will weaken. And because currency is a two-sided game, what happens when dollar weakens? Emerging market currencies would, on relative basis, be stronger. And within emerging markets, which are the currencies which will potentially be stronger, Asian currencies will be stronger. And the correlation studies we have done over the long term is that stronger Asian currencies equals stronger Asian equity returns. The correlation is very close. Okay, and given that Asia is so beaten down after roughly about 2 years of bashing, we are very cheap. Asia is very cheap. And a study done by a broker suggests that if emerging market allocations increase by 2 percentage points, that could potentially bring roughly US 500 billion in flows to this side of the world. Already year to date, some of the best performing markets has been Argentina and Mexico, little known places, but they're part of emerging market. And some of the biggest flows we have seen came in this year to Taiwan and Korea. Why Taiwan and Korea? Curiously, right? Bear in mind, Taiwan and Korea are very big technology economies. But didn't global semiconductor sales continue to come off in January? The thing is, forward expectations is important because a forward expectation is peak interest rate, weaker dollar, stronger Asian currencies, and as Kim has also mentioned, falling interest rates, falling bond yields equals repricing in growth assets, technology stocks, for example. So tech-driven economies in North Asia has started to get flows as far back as October, November last year. Year to date, they remain positive foreign fund inflows. Really, the choice picks in the region, tech. So the interest rate cycle, peak interest rate pivot equals the tech pivot. The other main pivot, and that potentially could drive a very big part of this part of the world, is the China pivot. The China reopening story is very strong. Look at Malaysia, how we have reopened in the last 10 months, 11 months. We've seen so much activity that's built out and therefore translated into consumer spending. Do not underestimate the power of spending from China. One of the first priorities when they reopened the economy was to see their family if they've not seen them in 3 years. So domestic travel has been the main priority. But still, after they've seen their families and friends, they are still 40% away from the 2019 peaks. How about international travel? International travel is 90% of its peak in 2019. Just follow the trail of money. Where would they go? Which countries would they visit? Who are likely to benefit? This is where China will potentially fuel the earnings growth of some companies around Asia. So these are the two main themes we're looking at in regional investments.
All right, thanks, Chris. Ivan, would you like to add on to this question?
Yeah, yes. I just want to say thank you so much to Chris and Kim. I think, yeah, I think I mean, both of you actually explained very, very well. And I just want to chip in a little bit. I think like what Chris just now been mentioned that falling on the bond year definitely be good for tech sector as well as the bond market. So to my understanding, in my opinion, I think sometimes it's very, very hard for investor to time the market. So therefore, I think diversification is necessary, and hence the investor should be able to choose the right fund manager, especially when it comes to the managing their funds to protect their investment assets. Asset rebalancing every 3 to 6 months is a necessary as well, just like how we run through our body medical checkup on a yearly basis. Has the investment fact changed, I think, every quarter? So it will be uh, more proper for investor to do or to consult their financial consultant or RM, or even met up with this so-called Phillip Capital unit trust consultants on the quarterly basis to review and assess their portfolio constantly. I think is a necessary moving forward. That is sort of like, yeah, a quick sharing from myself. I think back to you, Violet.
One questions. So we have heard of this so-called ChatGPT, and do you think this is just a hype or is it really a game changer? Yeah. Anyone can take that question?
I can start first. I've yet to see how they monetize it. So if we can deduce how they monetize it, then we may have a strong case of how we can take this forward. But if you embed ChatGPT into search engines, for example, that translates to maybe more clicks, more advertising. Again, that's one way to monetize it. Would there be a dedicated ChatGPT service?
And yeah,
maybe a ChatGPT friend, right? Where you pay a subscription service and you chat this person the whole night. They charge you by the hour. I don't know. Maybe that's one possibility. Are there dedicated stocks or startups doing this? I don't know yet. Are they investable? Probably not. Probably loss making. So it's really about at what point would it be viable? So from a stock investment perspective, if we follow our investment process and we are paying attention to cash flows, whether they're generating profits, probably not. So maybe the embedding of the ChatGPT will be on existing services. So I can think of the e-commerce giants in China trying to monetize it. So it remains to be seen how they monetize it, right? So you have to bear in mind, like the Facebook, for example, ran Facebook for free for so long. Then suddenly you started seeing ads and you started doing Facebook Marketplace and so on and so forth. That's when they really started doing it. So it's the same question we asked. Will Metaverse be money spinning for Facebook? Not yet, right?
Yeah, and we know that this thing, ChatGPT, will replace a lot of the jobs. So do you think there will be a change in the job structure moving forward, that many of the jobs that are repetitive and require that can be done with automation will be replaced? Yeah, Kim, what do you think about this?
I think it's possible. I'm not a fortune teller, so I don't know what's the outcome ultimately. But I think it's important for individuals like us or even corporates to stay relevant, look at the trend, what's the best to capitalize it and grab the opportunities, and to upskill ourselves and to look at multiple opportunities ahead. So the key thing is, to stay relevant. If the environment requires us to pick up some data scientist skills, then it's time for us to learn and maybe relearn.
I agree with Kim, I think, in the sense here. I think in fact Google also, they come up with another ChatGPT similar model like Bart.
I think we can be worried on some specific areas. I think if we look into centuries and centuries of technology and automation, humans have continuously been displaced. Where we used to farm the land with our hands, we now use tractors and machines. plow the land. So where we used to write something, now we ask Alexa, Amazon to do it for us, to answer calls, make calls for us, etc. All these are coming. I think crucially for us is where do we find our relevance? And this is where, in a space like a more high-touch space, where at this moment, technology is not able to replicate human emotions, contact, for example, a more personalized approach to things. I think this is where we still find relevance in.
All right. Thanks, Chris, Ivan, and Kim. So ultimately, the decision on which side, growth or value, to take should depend on an individual's financial goal, objective, and their risk tolerance and investment philosophy. So I think it's important to remember that there's no one size to fits all approach to investing, and a diversified portfolio that includes both growth and value stocks and where a portion of equity and fixed income is appropriate, and it might be the best way to achieve a long-term financial goal success. So thank you all for listening, and thank you all of the panelists to share your insight. It's really insightful today. This is a really thought-provoking discussion. So thank you all for coming.
Thank you.
Thank you.
Thank you so much.